We talked about minor pivots, we identified that, and today we are going to talk about how we can identify our range of price using minor pivots for higher accuracy. If you trade in the direction of minor pivots in your day-to-day analyzing, I assure you that it is going to change the way that you look at the market and increase your results substantially. When you get mastered in it after a lot of practice, you can see that how the markets always show you the next direction of the market in earlier stages using minor pivots. So today we are going to use minor pivots to identify our range of price. Hello, how are you? I hope that you are having a great day. I'm Mehran, your trading companion, and today we are going to talk about our range of trading or our range of legs using a very powerful concept named minor pivots. Before starting the lesson, this is Leo, your trading companion's companion, and it won't give me my blankets back, so your support can help me buy some blankets for myself because he is not going to allow me to sleep on my own. So what is a range of trading in simple terms, and why is that so important? We said that you should first identify your primary range. And what is a primary range? Is the last obvious high to the low or the last obvious swing high to the swing low. That range, that leg is our primary structure, and we wait until the high or the low gets broken. For example, here our high got broken with a strong move. So now we have our primary structure broken, or we have a break off structure. Let's change that to a break off structure. Now from this point, let me clean that up. From this low to this high, I mean the low that broke the last swing high, to the high that started the pullback, it is our range of trading. I'm not talking about ranging markets. I'm talking about the range, the distance that we can measure, and we can find out how to use that to trade first pro trend, and second we can measure that leg to identify best zones to trade in those zones. So from the last low that broke the high to the high that started the pullback, which is our protected low and our targeted high, it is our range of trading. And we can, for example, measure this leg with a Fibonacci tool, and we can identify our best POIs. I didn't want to use Fibonacci levels for accuracy, but because I looked at so many charts, I spent thousands of times on the screens. You can see that my subconscious made that point a Fibonacci level. Anyway, so again, when the last primary structure that is going to be from this low to this high, let me mark that for you, from this high to this low, it is our last obvious high and low when this movement starts. So it is our primary structure. When we have a break off structure here, we can say that it is our protected low, so this is our leg. What now? We can measure this leg and try to catch higher lows. So it is our trading range, I mean from this low to this high. And when we have our primary structure from here to this low, and the market comes down and break that low, so our trading range is from the high that broke the low to this low. So it is our trading range. We can measure that and we can mark our POIs in the best levels, I mean after the 50% off the leg. I'm going to talk about this tool, how to use that, how to change the setting, and how we can identify best POIs using the Fibonacci tools. But today we want to use minor pivots to identify this range in the early stages. For example, if you want to trade this up leg, you can't use any kind of things that is going to provide you with a good opportunity to long these positions, but with using minor pivots plus our trading range, you can identify these movements in the early stages of that move. Let's talk about minor pivots at first, and then we mix these two concepts together to increase our trading results. Now, what is a minor pivot? A minor pivot is when the market is going up and make higher highs and higher lows, and then it comes back and breaks the low. Or the market is coming down and making lower lows and lower highs, and then it comes down, break the last low, and then it breaks the last high. It is a minor pivot as well. It's better for the market to print some imbalances in the way up or in the way down, in the last leg that broke the high or the low. What is an imbalance? It's the space between first candle and the third candle of a three candle formation. For example, we have a three candle formation here, and those shadows should not touch each other. For example, it is like this, and this space between these two candles is an imbalance. So it is a three candle formation that the shadow of the first candle doesn't touch the shadow of the third candle. This pure body is called imbalance. And why is that so important? Because it means that it's just buying pressure and the sellers didn't have the time to enter the market. So when the market comes back to this zone, it will act as support. Now we want to mix the concepts of minor pivots plus trading ranges to identify the first stages of an impulse move and the first stages of the pullback movement. The impulsive move is simply the bigger move that moves the market, and the pullback move is just a retracement that is the market seeking liquidity or creating liquidity for the next impulsive move. So the impulsive moves move the market in a higher distance, and those retracements or pullbacks is just the correction movement, and then again an impulsive move. Now we want to see how we can identify this point and this point using minor pivots, and how we can identify our leg that doesn't change with the protected leg or the pullback leg, how to identify those legs with minor pivots for more accuracy. Let's imagine the blue lines are our daily charts and the red lines are our 4-hour. For identifying the start of your pullback or the start of your impulsive movement, you should go to lower time frames. For example, if you are seeing the daily like this with no fluctuations or volatility, you go to 4-hour time frame and you see that volatility on 4-hour, and you identify your range of legs and your minor pivots in a lower time frame that is going to be 4-hour. So the red line is our 4-hour chart. So when we have daily like this, we have 4-hour like this, it is going up and up and up, then it makes a minor pivot and it comes down, it makes a minor pivot and it goes up, it makes a minor pivot, goes down, and it makes the minor pivot and goes to the upside. So let's zoom in. So when we are going to look for minor pivots, First, we are going to use Fibonacci tools in the future, and I'm going to show you how to use them in the correct way. But now we don't want to mix things up. And now, after a break of structure, when the market, for example, break this structure from this point, we can wait until the market hits something that can be a round number, support or resistance, or an order block, and after the market breaks a structure like this, I want to use some other colors here. Green is good. So when the market breaks its structure to the downside after a break of structure, we can say that our pullbacks starts here. So it is our pullback, and it comes down, it comes down, it comes down. When the market go farther than 50% retracement, we can say that, if I use the farther correctly, we can say that we can wait until the market breaks its structure, its internal structure, and make another minor pivot to the upside. So we can say that this pullback has finished its job, and the market is going to start its impulsive move to the point that again it breaks some structure and it makes another minor pivot to the downside. But the important thing is that it is better to print some kind of imbalance in the way down that we talked about. So let's see this on charts. Before that, let me explain why these concepts are important. First of all, you can't find any other kind of concept that is going to provide you the start of pullback with this precision. So after a break of structure, we wait for the minor pivot to start to sell the market. If you want to sell the pullback, that I don't recommend, but some people want to catch these movements too. So when the market breaks a structure, we are going to use our Fibonacci tool. So when the market breaks this structure and comes up and makes a minor pivot to the downside, we can say that we are allowed to start to think about selling setups. So before that, we are just going to buy the markets, and when the market comes down and go lower than 50% retracement, we can wait for another minor pivot to start the up move. So before that minor pivot, we are not allowed to look for buy trades. When this happens, we can identify our order blocks, identify our imbalances. We can use fractals to go to lower time frames to enter the market. I talked about them a lot in this channel. You can find a lot of trading setups in this channel, like ultimate smart money videos, or ultimate liquidity videos, or ultimate stock market setups and videos. You can find them on ultimate playlist. But anyway, when you know some buying setups and selling setups, you should pay attention to these minor pivots, and after a break of structure, you can start to look for those setups when the market starts to go down, and after more than 50% retracement and creation of a minor pivot, you can start to see for buying setups to the upside. Let's see that on our charts. I'm going to use just 4 hours for this concept, and we can see the results. For example, the market is going up. We say that it is our minor pivot. Let's change that color. And the market made some pivot here and made some imbalances here, for example. And you can see that it came up. When the market breaks this structure and makes some minor pivots here, you can start buying the market, but this candle is a little bit dangerous. I don't trade after these movements, V-shaped movements that can be two candles, that can be a couple of the candles, or that can be just a long shadow. When the long shadow is too big, for example here it is a big V-shape market movement, I don't trade in that direction or in the opposite of that direction. So we have our primary leg here. You can see that this high broke this low, so we can use our Fibonacci tool, and after a 50% retracement to the upside, we can look for minor pivots. You can see the minor pivot here. It even printed some imbalances, and you can see the result. What is a minor pivot? When, let me zoom in, when the market goes up, break the high, and then comes back and crush the low. So after this movement, we can say that we can sell the market, and we are allowed to sell the market and try to find selling setups. After that, we wait until the market breaks the low. When the market print another minor pivot, you can see that here. Let me change this color for you. You can see that here it made some minor pivots. You can start to buy the market to the point that it has another 50% retracement and make another minor pivot. You can find that here. So after this, you can start to look for selling setups. The market came down after it broke this low. It is a little bit risky because it didn't break this low very well, but you can try to buy the market after a minor pivot. Let me see where the minor pivot is created. It is not a minor pivot, so we don't trade this point because it should come up and break this high to create a minor pivot. But anyway, but you can find selling setups after a 50% retracement. You can say that it is our minor pivot, and you can see the results. So after that, after this big movement, you can find another minor pivot here, or if you are looking for very specific, very a small fraction of markets, you can say that it came up, it made a higher low and a higher high, so the market is going upward, but I don't recommend to do that. After that, you measure this leg, and after a 50% retracement, that's going to be here, you can start to sell. But after these big movements, you can use 38.2, but I don't talk about that because I didn't mention that anyway. After this break of structure, you can start to buy the market after a minor pivot. The minor pivot happened here. It wasn't a good move. It's why I recommend to use only impulsive moves in the trend and in the direction of the break of structure, and it is a pullback movement, so I don't recommend to use those pullback movements. When this come down and break the low, you can start to buy the market after a minor pivot to the upside, and you can see the results. And when it retraces more than 50% of this protected leg that we talked about, these kinds of concepts in the channel, in the free smart money liquidity course playlist. You can find those videos on that playlist. You can say that after a 50% retracement, we can look for minor pivots. Our minor pivot is here because it went up, it broke the high, and it went down. And our real minor pivot, our not aggressive minor pivot, is this point, and you can see the results. So go practice these concepts, and you can see how powerful are these concepts. But after getting mastered in market structure, break of structure, and its types after learning what is a minor pivot and mix these things up. Thank you for your watching. We are in a dark time in our country. We don't have a good internet connection, so I can't trade consistently like the past. So your support, your subscriptions and likes and comments help me a lot. So thank you for your support and for watching this video. If you have any kind of questions or if you have any kind of objections, you can ask them in the comments below, and that helps the channel too. Thank you for your watching and goodbye.